Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the Stock Play of the Day. Today's stock is J&J. That's Johnson & Johnson. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
Well, Lindsey, we have a mixed marketplace here over the last couple of weeks in the S&P 500 index. It looks like it's dancing with all-time highs. What do we see going into this week?
Yeah, the last couple of weeks have been choppy, but this Monday, just like the past two Mondays, we got some vaccine news, which has injected a little bit of optimism into the market to start the day. We have seen the Nasdaq come down. It's a little in the red slightly as the moment that we speak here, but got the S&P 500 and Dow still in the green. S&P 500 losing some steam, but what is well in the green again this morning is the Russell 2000. So the small caps are doing well this morning, just like they did last week. We saw that rotation, despite a choppy market, really continue into the last couple of weeks and into this morning, where you see industrials, materials, energy companies, as well as the small caps and value-oriented companies doing well. So we're seeing that trade continue and be supported this morning, and that's all because of vaccines. Once we get the vaccines out there, right, people are more likely to go out. The economy can continue to reopen. So this is despite the news that we've seen of coronavirus cases hitting new highs. On Friday, I think we had over, 195,000 cases announced. So the numbers are pretty dire. We're seeing some restrictions put back into place in different states. But the market is looking forward to 2021, Brian. But if we look back at the chart of the S&P 500, we've been looking at this chart every Monday for the last several weeks. You've got that red line at the top there, which is, what do we got? 3590 or 30. Right. 3590. Yep. So that seems to be kind of a level, a little bit of resistance that we're trading around this morning or over the last couple of weeks, and we'd like to see the market move above it and sustain levels above that to regain momentum. But this is Thanksgiving week, so it's usually a light week, but we do usually see the market perform pretty well. The S&P 500 has historically, since 1950, advanced 0.7% during the week of Thanksgiving, which is really only about 3.5 trading days, which unlike your normal 5-day trading week. So that's better than what you would see on any normal week. So, hopefully the trend continues this week. We'll see. I expect it to remain choppy. I think that once we get through this holiday, investors are going to really be thinking about how the consumer is going to react this holiday season, how their spending is going to look. And then as well as what a coronavirus fiscal aid package can look like from the government. There's potential, because the government has to pass a budget before the end of the year, that we could see something wiggled in there to help the businesses and consumers that are being hurt the most. But we will see. The other thing I want to talk about, economic data this week. This morning, when the market did reach the high, it was on the back of some manufacturing data, PMI data. So both actually manufacturing and services data came out this morning, was really very strong. Let's take a look. The manufacturing PMI came in at 56.7. That was the highest level in 74 months. The services PMI came in at 57.7, the highest level in 68 months. And the survey said overall the expansion was the fastest that we've seen in 5.5 years. And that's a really good sign for the economy. Now, there's concerns that we're going to see a little bit of an economic slowdown in the months ahead because of the increase in the coronavirus we'll definitely be keeping our eyes on that. But all that being said, Brian, we look at the VIX this morning and it's kind of flat, not doing too much. Last week, we've been in these low 20 levels here. So, are we getting closer to being out of the woods now that we've got the election uncertainty for the most part behind us? We're being hopeful about what 2021 could bring because we have a vaccine. What's the VIX telling us in your viewpoint?
Yeah, the VIX is always an interesting topic. Every week we keep thinking, well, I guess we got to address the VIX again because it stays stubbornly above that 20 level. And I'm going to highlight this over here on my chart on the right-hand side. We see I've drawn a horizontal line right at the 20 level. And we see that we kind of touched that leading into the news of the pandemic, but we've never came down and breached that level since our big downturn in March. So I find that to just be an interesting level. It'd be really nice to see the VIX get below that to follow the Russell. Like you mentioned, the Russell 2000 setting new highs, leading the way in these markets is just kind of confusing to have the small caps leading us out of this, I guess, doldrums of the marketplace. The S&P 500 index, like you mentioned, we're dancing with that one level just to try to decide which way we'd like to go. As a matter of fact, I mean, if I look at that just kind of says to me, I know it's going to burst some way in some direction. It's either going to make a strong move to the upside or the downside. It's just trying to figure out which way it wants to go. And the VIX isn't helping much. The VIX, even though we've had the slower day-to-day movements in the S&P 500 index, the VIX, which tracks the volatility of the index, still remains high. That means a lot of people are probably using it to buy insurance. They're buying puts, out of the money puts as protection. They're still nervous about the marketplace and not necessarily believing in the rally overall. So if I go out in time and I look at the futures contracts, as we see on my VIX watch list, we go out to January, February of next year, the VIX is still up over that 25% range. So the marketplace is expecting the VIX to go higher as we head into the new year, not lower, which once again would be counterintuitive to me overall, considering we already had the election done. We've already had the news, some good news on the coronavirus front. And you would think that might drive the VIX down below the 20 level. So that's a level that I'm going to be watching on the VIX. It'd be nice to see it down there, bring back some less uncertainty in the marketplace overall. And I just think in general, the big boys would feel more comfortable if we got that VIX down to that level to help us drive to new highs in the marketplace. All right, today's stock is Johnson & Johnson. Speaking of the coronavirus, we have a chart here, and there's been obviously a lot of news in this sector. Lindsey, what are your thoughts on Johnson & Johnson and also some of the other stocks in this sector that have announced vaccines?
Yeah, Brian, we decided to look at Johnson & Johnson because the last couple weeks, all this vaccine news is coming through every Monday. Maybe next Monday will be J&J's turn with some news on their vaccine. We're not really sure, but we thought it would be a good stock to look at. But before I get into that, I just want to remind our viewers that we will take your questions live here at the end of the show. Brian and I will answer whatever is on your mind about the healthcare industry, J&J, the market overall. Just type it out in the chat box over on the right. We'll get to as many questions as we can at the end. All right, so Johnson & Johnson, this stock, if you look at it, I'm glad you pulled up a little bit of a longer term 1 year chart here is what you've got. If you really look at it between, I think it's May and now, the stock hasn't done much. It's really been in this up and down in this range between 140 and 150. And we're kind of right in the middle of that now, just, in 144 and change. Actually, today we broke below the 50-day moving average, still above the 200-day moving average. From a valuation perspective, you all know, like I like to look at the PE, price to earnings ratio of stocks that we're looking at. Right now, it's trading at 17 times on a forward PE basis. That's in line with its historical average. It's in line with the healthcare industry, so it's not really overvalued. And on a year-to-date basis, the stock is overall flat. So it's been able to rebound off of the big drop that we saw earlier in the year, but it really hasn't done too much. So we're thinking, Brian and I were talking this morning, could the vaccine be a catalyst for this stock? And we do think it might be able to, because I don't know, Brian, you're going to pull up some of the other charts, but the first company that announced a vaccine with an efficacy rate of 90% at the time, and they recently updated it to 95%, was Pfizer. PFE is the ticker, and you see that big sharp jump right there that we're highlighting with the arrow. That was the day that the vaccine was announced. So we got a big pop. It's, of course, has come down since then, you can see, as the market settled and trades were made around it. But the other stock last week, we heard from Moderna, ticker MRNA. That stock too popped the day they reported earnings, came back in, and then popped back up. So we're just looking at J&J, and we think there could be an opportunity. When we think about options, strategies, and trades, you can go shorter term or longer term. And we're thinking it's possible to do a shorter term trade. And Brian's going to get into that in a minute. But when I think about J&J in general, overall, if we want to pull back up the J&J stock, fundamentally, this is a stock that I do also think vaccines mean that the economy is expected to reopen at a faster pace, right? So this is, believe it or not, as a stock that could benefit, maybe not as substantially as, say, the airlines and cruise lines, who are moving much higher this morning again and have been benefiting from all this vaccine news coming out. But they also, too, not only do they have the benefit of having a vaccine, they have other parts of their business, which is the medical device business, the consumer business. The medical device business in particular has been pretty weak over the last couple of quarters because a lot of the surgeries that are done with their medical devices aren't happening because of the pandemic. So it has taken a little bit of beating in that business, consumer business, hanging in there, but could do better potentially in a reopening. And of course, the pharmaceutical business within J&J accounts for 2/3 of sales. So that, we're looking forward to the vaccine potentially benefiting. A lot of these companies are expecting to offer the vaccine at a very low price to make sure that the distribution is out there and that everyone that needs it gets it. So we wanted to take a look at J&J. This is a stock, by the way, that has a 4% dividend yield. So even if we stay in this 140 to 150 range, or it pops on vaccine news and comes back in, you're still going to earn that 4% dividend yield, which is way better than the less than 2% yield you get on the S&P 500. And we won't even talk about the treasury market. You can't make any money putting your money in treasuries these days. What's the 10-year, I think, is at 80 basis points, maybe 82, 83 basis points. So there's not a lot if you're looking for yield, and J&J could be one of those. Now, that being said, to be fair and balanced here, I have to say they do have legal issues with their talcum-based baby powder that has, they're going through court. There's accusations that it causes cancer. There's also concerns that these guys played a role in the opioid crisis. So those clouds do weigh over the stock, and perhaps that's why the stock hasn't gotten too far above its highs from earlier in the year. But there does seem to be some opportunity in this stock, and potentially a vaccine could be a catalyst. You saw the pop in the other charts that we just went through. So that's why we thought it'd be good to bring through and consider an option strategy, Brian. So I'm going to pass it over to you and let everyone know what you're thinking, where the opportunities lie from an options perspective.
All right. Well, I'm going to start by looking at the chart here real quick, and you mentioned the 50-day and 200-day moving averages, but I kind of saw a line here that seems like it touches a lot of interesting points on the J&J chart. And right now we're kind of bouncing off of that. And it's kind of odd to me overall that the stock has had a fairly big down day. I guess the other people are beating them to the news that they have vaccines, and the vaccines are all performing really well. But a big thing, Lindsey, that you and I talked a little bit about today The difference could be on a lot of these vaccines, and why we saw Pfizer come back down after it set its initial high after the news is that does the vaccine need to be refrigerated or not? And that's kind of a big thing. They're indicating that Johnson & Johnson's may not need the refrigeration like the Pfizer vaccine does, and that obviously can be beneficial. But overall, they're just going to be making vaccines. They got to pump them out across the world. As long as they're in that 90% range, there's a good chance that they're going to be distributing them all over the entire globe. So with that said, we're going to look at a conservative but speculative play here in Johnson & Johnson. This is actually going to be called a long call butterfly spread. And with the long call butterfly spread, what you're doing is you're going to get a nice range of prices that the underlying stock could land in. The one benefit of a long call butterfly spread, as opposed to just buying a call outright, is that it does not mind as if time decays as expiration approaches and you're correct on your forecast. And you can greatly reduce the cost overall of just, as opposed to buying an option outright. They're usually fairly inexpensive, and your risk is just what you pay for that underlying. So now, this is a little bit more advanced trade than we usually talk about on the stock play of the day. But what we're looking to do is we're going to go with the calls. We're going to go a little bit out of the money on the call side. So we're going to look for a move to the upside, and you're going to be buying one option contract, selling two of the middle strike, which would be strike B on the options playbook website. And then we're going to be buying strike C, which is actually our protection. Our goal here is that it remains within these two strikes. It remains within this range. So we're going to make it a fairly wide range. And we're going to go out in time. Now, we don't know when the phase 3 trials would be announced. That would be basically insider information, right? So if we're doing this paper trade, we're going to try to give it enough time that it could potentially be announced within the expiration time period. Now, I'm going to emphasize, not meant to be a recommendation. This is definitely a speculative trade. We're just trying to learn here on the stock play of the day. So let's get to the LI Invest option chains. And the right now we see Johnson & Johnson down 1%, down 1.59 on the day, trading at 143.78. This is the dividend that Lindsey was talking about, a quarterly dividend of $1 a share that they're paying. So that's showing you the yield. Earnings and all that has gone by, so we're not going to have to worry about things like that. We have a plethora of different expiration dates. Picking the expiration date is fairly important on a butterfly. I'm going to go out 25 days, but we really, if they would be nice enough to share when they think they're going to announce the phase 3 trials, that would help a lot. But that's part of the reason why we're going to greatly reduce our overall risk of this trade by doing the butterfly as opposed to just buying the call outright. It limits our potential upside, but it also limits our risk overall. Okay, so let's look at this trade. December 18th expiration, 25 days away. We're looking at buying the 145 strike call, selling the 150 strike call. Remember, that's strike B inside the options playbook. And then going equidistant, even though the strikes, they got 1 point strikes here, we're going to go 5 points away from the option that we sold and buy the 155 strike call. Now, if I do this entire trade, a 1x2x1, you enter it all as a gaggle of options down to the trading floor. And we can get this trade done for a net debit to the account of $1, basically 97 cents. That means if I do this trade in its entirety, 1x2x1, that's how I send it to the trading floor. My maximum risk on this trade is going to be $1. Now let's compare that to just buying the 145 call outright. Because here's, when we're looking at a speculation type trade, we want to manage that risk. That would be about a $2.50 trade. So we're more than halving the total risk of this trade, right? If we bought this option contract outright, our total risk would be $2.50. By doing the butterfly, we want the stock to get to 145 and beyond, but our total risk now is only $1. Okay, there has to be a trade-off. Well, let's officially make this the paper trade. I'm going to put this over in the right rail. I'm going to emphasize once again that we're just trying to learn. Fairly advanced trade. We're going to put it in at a net debit. We're going to say we'll go 90. Yeah, we'll go 95 cents. Let's try to work the trade a little bit. The more legs that you have on the trade, the better you chance that you're going to get a midpoint fill on that trade. I'm going to highlight here that on our quotes, we're showing the midpoint. The actual ask is 108. If we put it in at market, that's what we'd expect to pay. We're going to try to work it a little bit. So we're buying open one of the December 18, 2020 expiration, 155 strike call. We want the market to go beyond that. We're going to be selling, or I'm sorry, we want it to go just below that, I should say. We're going to be selling two of the 150 strike calls, same expiration, and then buying one of the 145 strike calls. Now that's the strike that matters to us. As opposed to buying that strike outright, we're going to do the butterfly. We would like the stock to go above 145 and then stay between this range. We're only going to be paying $1 for this trade, $1.95. That would be $95 per 1x2x1 butterfly. And don't forget to add in commissions. That would be our total risk of the trade. All right, so let me scroll down to our profit and loss calculator. And I'll highlight what the graph would look like and talk a little bit about what our expectations are over time. I have my screen zoomed in here, so let me adjust that. So right here is where the underlying stock is, and it's being represented by that gray line. We want the market to go up to 150, but if it goes up fairly fast, our profit potential is a little bit lower. Our maximum profit at expiration would be $5, the width of the spread, minus the $1 that we paid for it. Now, you don't do a butterfly expecting a home run per se, right? In that it's very hard to get the maximum because the stock would have to stop right here at expiration. Now, as expiration approaches, this is where our profit and loss is at right now, which is the colored line. Now, I'm going to push this all the way down to, say, 2 days to expiration. And now you see that graph change quite a bit. So here's why I struggled with picking the expiration date, because we'd like to see this move to the upside. We're assuming that it might be news-based, but in order for a butterfly to get close to the maximum, you need it to be correct closer to that expiration date. So picking the expiration is fairly important when you're looking at a butterfly. But then again, if we go all the way back to the chart where we were at, you can't really get hurt. If you're correct on your forecast, you can just close it out when it gets to your short strike and you move on. So if we're paying $1 for this, maximum we could receive is $5, but don't get greedy. You're looking at on a butterfly. If I'm paying $1, I want to basically make $1. I'm risking $100 to try to make $200. If I can get $2 for this trade, I'm just going to get out and move on with the trade. And so overall, that would be my upside risk. Now, if you wanted to, on the downside, we've already reduced our risk quite a bit by doing the butterfly. But on the downside, sometimes people will say, well, if I lose half of it, if I paid $1 and it starts trading for around 50 cents because the market went down, it went against us in this trade, then I could get out of that trade. But to me, this is more of an all or nothing trade. I'm going to put it on. If it goes down, I lose the $1. On the upside, I could make the $1. I might even be able to make $1.50. But overall, when it gets above $2, I want to think hard about closing this trade. And that's an if it gets above $2, correct? All right. So that is the long butterfly call spread in Johnson & Johnson. And basically, this is what it looks like inside the options playbook. Now, I see a lot of questions coming in, Lindsey, over here. Which one you want to start with in our chat box? And if you have a question, please make sure to put it in the chat box. We'll try to address as many as we can before the show is over with. But I'll let Lindsey pick one to start with. I'm not hearing you, Lindsey, right now.
I muted myself. So
all right.
Questions coming in. And we look forward to answering them here. So Carol Hagood asked a really good question. Why not put spread for this trade?
All right. So why not look at a short put spread, which we did last week? We actually talked about a short put spread in DocuSign last week. It's not a bad alternative, but I think there's too much risk overall. In DocuSign, we were actually, so just to do a comparison, we were trying to do a speculative short put spread before the big news came out, before the earnings happened. And that was because implied volatilities were really high still in DocuSign. So that made doing a short put spread a little bit more enticing. In Johnson & Johnson, if I show my chain here just a little bit, we see that implied volatilities aren't that bad. They're actually right around the 20% level in the stock, considering there's still a lot of news out there. DocuSign was up around 40% implied volatility. So we took advantage of that trade by doing a short put spread, hoping that it would just stay where it's at or continue higher before that announcement in the earnings. So our expiration date we chose specifically so those option contracts would expire before we ran into that earnings report. Totally different situation here. We want to manage our risk. Who knows after the phase 3 trials where that underlying stock can go? It could be really good for the stock. It could be really bad for the stock. So by managing our risk here with a butterfly, I think it's a more interesting trade where with a short put spread, you have more risk than reward. With the butterfly, we have the potential for more reward than the overall risk. And so that was the thought there.
Got it. We got a couple more questions coming in here. Wayne says, hey, Lindsey, Brian, happy Thanksgiving. Happy Thanksgiving to you too, Wayne, and everybody else watching. Can you explain how this trade benefits us more than a bull call spread?
All right. It's mainly because of time decay. Now, two things. First of all, a bull call spread overall usually will cost more. It will cost you more to put that trade on. So that means you have more overall risk. But the other side of it, when I'm looking at the bull call spread versus the butterfly, if you're correct on your forecast, doesn't mind a crunch in implied volatility, doesn't mind time decay as much. Those are your friends in the butterfly. Now, the bull call spread addresses it a little bit, but in the butterfly, it's a benefit of that trade if you're correct on your forecast. So it's not a bad alternative. And honestly, I thought about doing a bull call spread today, but I knew this was a speculative trade, so I wanted to get the overall cost as low as possible, hence reducing the risk as low as possible.
All right. Next up, Ramman AR. How do you find which stocks or ETFs have high implied volatility? We get this question from time to time, Brian.
All right. Well, there are some software out there that will actually do a search for high implied volatility. You can obviously just look at the chains for the underlying stocks that you'd like to know the implied volatility for. And then there's also implied volatility charts. Looks a lot like a stock price chart, very similar to the VIX chart that I showed you that will highlight that implied volatility on those underlying stocks. But we always, when we look at implied volatility, we always reference the most at the money option contract. Like here for the December 18th expiration, the stock's at 143.88. So the implied volatility that we mentioned for that expiration is basically a 20% implied volatility.
All right. And then, so there's another question. We've got a newbie with us, Brian, today. We've got Hat 3131 says, hello, I'm brand new to stocks. What would you advise my first step to learning more about stock be? What sources should I look into? Thank you both for all the good info and take care. So what I would say is that there's a ton of good books out there. There's good tutorials out there. We at Ally Invest have a guide. It's called the Clutch Guide to Investing. If you just Google that and Ally Invest, it should come up. But also the one book, I recommend several different books often. But one book that I always go back to when you're just starting out is The Intelligent Investor by Benjamin Graham. It won't disappoint you. You should check it out. Brian, is there anything that you would point to? I'd also point to just reading CNBC.com or Yahoo Finance. That'll give you a good feel of what's moving markets on any given day and what investors are really focused on.
Well, in my world, it's more so about the option trading in the books. And I always highlight here on the stock play of the day is the options playbook, which is it's got some stuff in there for the advanced trader, like the butterfly that we're talking about, and also about just the basics of option trading overall. So the options playbook, which is actually free online, the whole book is on optionsplaybook.com.
All right, Brian, I think that's going to do it for today's stock play of the day. But before we close out, just want to remind our viewers that Brian reviews the trade that we talk about on Mondays. He reviews it on Fridays at noon right here on the Ally YouTube channel live. It's a shorter episode, so he gives you great ways you can think about tweaking the trade depending on what happened in the stock over the course of the week. Be sure to tune in. He'll be covering the J&J trade then. So that's all we got today, Brian.
Yeah, and we will be doing it this Friday, even though it's going to be a half day as far as the markets are concerned. We will be doing the stock play of the day overtime. So please sign in. We'd like to get as many people there as possible. And in order to receive alerts on it, please click subscribe and ring the bell. And then we'll see you this Friday on the stock play of the day overtime. Happy Thanksgiving, everyone.
Happy Thanksgiving.